Hey, thanks for joining us today in Major Players, where I bring you a major player, somebody playing a big game in their space. And today I got my guy Tait Duryea. I never say your last name. I always just say Tait.
Duryea.
Duryea, you got a cool last name. That's better than Bell.
That's it.
So he runs Turbine Capital. He did ultimately you deal with pilots, right?
Right. Now, hey, yeah, that last name's pretty cool. I don't have a helicopter company named after me, so you're doing pretty well.
I'm working on it. So cool. So thanks again for for being here today with me and having me as a host. But man, so if you don't mind, kind of introducing a little bit about you and what you do and how you work with people in your investment space.
Yeah, absolutely. So just some background, I grew up in a very middle class family. We didn't want really for anything, but at the same time, my parents weren't killing it by any means.
Mhm.
And I grew up around uncles who were airline pilots. My two grandfathers were airline pilots.
Okay.
Sorry, well, they're both pilots. One grandfather was an airline pilot. One was a military pilot. And the two uncles that I grew up with very closely were my mom's two brothers, and they did really well for themselves. And but I think they thought that they did better than they actually did.
Mm,
And what I mean by that is they were brought up to think that a six-figure income was killing it.
right.
And I could see at a very young age that that was not the ceiling.
Mm,
And I wanted to push those boundaries. I wanted to see what else was out there.
right.
And I read Rich Dad Poor Dad when I was in, I don't know, junior year of high school. That really resonated with me. Saw that there was more beyond the horizon than just a six-figure W-2 job. And I actually wanted to go into real estate and entrepreneurship and all that, having read a bunch of follow-on books about real estate investing and building wealth. And I wanted to go straight into that out of high school. I actually didn't get into USC. I got a denial letter. And so my backup plan was flying.
Oh,
And so I am very, very fortunate that I ended up going down that route because it was a fantastic career in aviation. It really matters how you time it. And not that
mm,
you have any control over it, but if you time the aviation career during a good cycle in the aviation industry, you have just a golden career.
mm,
And if you don't, it can be punishing.
right.
And there were people who are 10, 15 years to my senior who sat sideways in a DC-10 for almost a decade, went through multiple furloughs, just had a really, really tough career. And
Yeah.
I was very, very fortunate. I just timed it well. Got on with a major airline when I was 23 years old. Keys to the world, free travel, great six-figure income. I was able to spend most of my 20s just having a great time.
Wow.
And to anybody out there that is young and wants to get started, is chomping at the bit, my recommendation to you is get educated and get to some sort of a skill level where you can really start to enjoy your life, but don't go so, you know, full throttle in business that you don't get to experience your 20s because
Right.
man, that having that time in my 20s where I was able to travel the world and meet great people and
Mm,
have amazing experiences and go skiing in Europe and do these things, which you can do on a budget. You don't have
right.
to, you don't have to break the bank and stay at the Ritz. It was just incredible.
Yeah.
And I was able to, build a real estate portfolio during that time, but modestly.
Mm,
And it wasn't until I got into my 30s that I really decided, hey, okay, time to switch gears here and get serious.
right. Right. So, and I've heard over and over again, it's like the most important, like we go to any place, conferences, business people, things that we've met, even charities. The person who's the pilot, they're usually the most interesting people in the room. Everyone wants to talk to the pilot. So that's cool.
Yeah,
So,
there's the joke. How do you know there's a pilot at your party?
is
He'll tell you.
yeah, everybody's talking to him.
He or she will tell you. Yeah, it's
I'm a pilot.
it's not too hard. That's the
That-
joke.
yeah, no.
But yeah, it's a fun career. I always joke that it beats working for a living.
Yeah, yeah, for
So
sure. So how were you like, and I know you were kind of talking about your upbringing. Did your family, did they talk about money a lot? Did they talk about wealth and investments and things like that too?
You know, they did not. No.
Mm,
And that is my uncle, one of my uncles did. And when I would go over to his house, he would show me his Schwab account and his
mm,
and he wasn't into alternatives or real estate or anything like that, but he would sort of crack open the hood and say,
right,
okay, this is what we've got and this is how I think about it. And that was really helpful. And I think that was what opened my comfort level to talking about money. My wife and I talk about money all the time. I
right,
love talking about money. I think that wealthy people talk about money,
right.
even if it's not a positive subject.
Hmm.
If you are struggling with money, you should talk about it. Talk about it
Right.
with your kids. Don't hide that or sweep it under the rug. It's like, hey, we can't afford this because of XYZ. Here's our
Hmm.
financial situation. This is what we're bringing in. This is what we're spending.
Right.
Show your kids that because
Yeah.
it's so important for them to understand that, oh, this isn't it's a causation. It's not
Mm,
that mom and dad are stressed because money is stressful. It's like, no, this is the situation. This is the income. These are the expenses. And this is how we're thinking about this, and this is how we're manipulating things to get along.
right.
Um, Teach your kids about that. Talk about it.
Mm. Yeah, that's valuable. I talk to a lot of people in the, real estate space, investors, business owners, and I'm like, that's been a theme, even with what we're doing at major players. Like either I always say
Right.
like someone had an experience or somebody had exposure.
Right.
So sometimes people have, both, right? They were exposed to it where their family talked about money, they had success in the family, or they had an experience where it was a no more moment where like, hey, you know what? I'm tired of this situation. And that
Right.
was the catalyst to their success. So that's interesting, man. So, what I've said is like, how was little Tate? Like, were you like competitive? Were you like how were you growing up as a kid?
I was never really into team sports. It's so funny. I love working in teams. I love those school projects where we would get in teams, we could kind of divide and conquer. But when it came to, playing baseball or soccer or basketball, I was never good at those sports. I grew up in Bozeman, Montana for 10 years when I was, what, 4 till 13-ish,
Uh-huh.
and skied, mountain biked. I raced competitive skiing, but
Oh wow.
all the ball sports, boy, I was not good. I was not good. It was not good for my self-esteem being on the baseball pitch.
Yeah, yeah, yeah.
but
No,
but
I
I was a
get it.
great skier, great snowboarder, really really good mountain biker. I used to BMX race, things like that. So I was competitive with the individual sports. Yeah.
Yeah, yeah. So what drove you as a kid? Like did you just like want to be better or like was it things like
I've
that?
always
Like,
been very curious. I've
mm,
always been very
okay.
curious, and I've also had an innate um, sense that the worst case scenario is probably not as bad as you think it is.
Mm, yeah.
My bones are not as malleable as they used to be, right? But I remember when I was a kid, when I was mountain biking, I would say if you're not falling, you're not trying hard enough. Like you're not
Oh,
pushing the limits hard enough,
yeah, yeah.
because if you didn't take a spill, it's like, well, you weren't really pushing the envelope.
Mm,
And I think that I was just watching this interview with Alex Hodel. Is that his last name? The guy that he's a incredible mountain climber.
I
He
don't know who
he
he
just
is. I'll look him
he
up.
just climbed. He just free soloed Taipei 101.
Oh wow.
So 101 stories. He climbed the entire building with no ropes.
Oh, the one on
And
Netflix. The show on Netflix.
yeah, there's been a show on Netflix. I mean, he's done Half Dome. He's
Wow.
amazing.
Okay.
And he was just interviewed on a podcast, and he was talking about how people should have more experiences that expose them to real fear,
Mm,
because if if you don't expose yourself to situations where there are potential harmful consequences,
right.
then your your mind just makes things up. And he
Yeah.
uses the example of people being in an airport and they're so worked up. They're like, "Oh my God, what if we miss our flight? What if we don't get through security? Ah, and there's like traffic." And he's like, "Who cares? Like you are in a
Yeah.
climate controlled building. There's
Right.
food everywhere. It's like you're not going to die. You're fine, right?
Yeah.
So I think that we as humans, we build worst case scenarios up to be worse than they are.
Hmm.
And I think that it's so freeing to say, like, hey, even in a worst case scenario, you know, people all the time get worked up in the investing world. It's like, oh
Yeah.
my God, what if I lose money? It's like, well, you can make some more.
Yeah.
It's not
Yeah.
the end of the world. Like you're gonna make mistakes. If you are a sophisticated investor and you invest in enough deals, you are going to lose money
That's
in
right.
at least one or two of them.
Yeah.
It's just, but success is a terrible teacher.
Hmm.
Failure is a great teacher.
Yeah.
So get out there, push the limits. I don't know. So you're asking me, the original question was, what was little Tate like? I wouldn't say I was a necessarily a risk taker, but a calculated risk taker.
Yeah.
I was always good at determining, okay, what's the worst possible outcome,
Hmm.
and pushing that boundary to push myself to the point where there I was riding the ragged edge of failure.
Yeah. Yeah. No, that's cool because like you, like that's always been this theme that I'm noticing, myself included. It's like growing up, I would watch other people I'm a risk taker. I like doing risky stuff, but I also learn from other people's failures. So I'm like, all right, I watched that guy go. He did this. I'm going to avoid that, but I'm going to push the envelope a lot harder than he probably did because I also know where not to step, you know? So,
Yeah, and we say in aviation that you have to learn from other people's mistakes, because if you don't, you won't live long enough to make them all yourself. So, in aviation, you, every time you take an airplane off the ground, it's a calculated risk.
right.
But we get very very good in aviation with managing that risk, and I think that that's sort of the mantra that we take into the investing world.
I was going to ask you about that. So, like, how has that transferred over to you being like a great fund manager or with some of the investments that you've made over time? Because I would assume that, I always kind of tell people as a very baseline example, and you're probably like, but I was like, like fund management and syndication is almost like the example of buying a plane ticket to go someplace. If you want to fly from
Yep.
California to Hawaii, you're going to buy a plane ticket, and then you have two people that are the pilots. They're kind of the managers and
I
GPs.
use this example all the time. I love it. Yes.
Yeah, yeah. So like, how is that? How is your ability as a pilot helped you kind of be a great, being able to be great at being a fund manager and being able to manage other people's capital the way that you have?
So I think it starts with experience. I
Hmm.
think that, if we talk about, if we get away from being a fund manager, we talk about being a leader.
Yeah, yeah,
The
1000%.
first step of being a leader is knowing your stuff,
Hmm.
because nobody is going to follow you if they don't think that you know what you're talking about.
Right.
How do you get to know your stuff? Well, you study,
Hmm.
you get around mentors and instructors. A lot of times you have to pay to play, so
Hmm.
you gotta pay money to be part of masterminds and take courses and go to conferences and be around those people.
Right.
And you can't learn to play a sport by watching it on TV. You got to get on the field and start swinging, right? So
That's right.
you you got to get in the ring,
Hmm.
and that's really, I did all of the above. When I was, like I said, when I was in high school, I wanted to get into real estate, and so I was already consuming those materials, reading books. Podcasts weren't really around back then, but they
Yeah.
were by the time I was an airline pilot. So I listened to a ton of podcasts. I mean, you can
Hmm.
get a PhD in real estate by listening to 1,000 episodes of Bigger Pockets,
Yeah.
right?
Yeah.
Um, and then I started going to conferences. And of course, I was buying property as well. I bought my first rental property when I was 25 years old,
Mhm.
continued buying, stepped up into some multifamily, and then got into the syndication world and started investing as an LP. And, you want to start making some of your own mistakes first, uh,
Mhm.
before you start touching other people's money, of course.
Yeah. Yeah.
And yeah, I lost some money on some deals, but I also did very well in quite a good number of others. And really, what brought me to start my company, I started my company 6 years ago. It's called Turbine Capital. Turbine being a play on a jet engine.
Yeah.
So it revolves around helping other aviation professionals diversify outside the public markets into tangible assets that cash flow, provide tax benefits, and diversification outside the public markets, things that don't move in sync with the S&P 500.
Right.
And of course, we help other professionals as well, but our core demographic is other airline pilots. And the genesis of this was being at real estate conferences and rubbing shoulders with all these
Yeah.
doctor groups like Viking Capital and Passive Income MD with Peter Kim and Ascent Equity Group, same guy, but which is his PE platform. Um, White Coat Investor. I mean, there's
Yeah.
dozens, and nobody was doing this for the airline pilot crowd. And I thought, God, what a shame, because I wanted
Mhm.
to go and join a group of my colleagues who
Yeah.
had these same interests and were coming together to learn and to grow and to build wealth. And since it didn't exist, I said, you know what, this is a perfect opportunity. And so I jumped in and I created it. And it was a slog, absolute slog for 6 straight years. But what we're really hitting our stride now. And
Mm.
we've got about 34 projects under management. We'll do another 9 this year.
Yeah.
Um, about 550 active LPs and growing,
Wow.
and a very large education platform called Passive Income Pilots that is a podcast, and soon will be a master class and a mentorship program and things like that. So, kind of
Wow.
hit,
There you go.
hitting it with the aviation crowd, because the 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 unfortunate thing about med school or flight school is the one thing they don't teach you
Hmm.
is how to manage a $500,000 W-2.
That's right.
And that's what happens when you become an ER doctor
Hmm.
or an ENT or a surgeon or a pilot. You
Right.
you get dumped into this career, and all of a sudden you're making four, five, $600,000 a year. You're getting hammered on taxes,
Hmm.
and no one has given you any career advice or financial advice other than max out your 401k. And it's like there has to be more to this.
Right.
So in any case, that's what we're helping our community unlock.
Man, I love that. I love that. It's interesting that you say that because, I started off, geez, 27 years ago. I've done about 60, well, $59 million worth of real estate myself, right? And I just started, this is my first time fund. Not a first time investor. I did everything you said. And the bigger challenges for us is in still growing the fund and raising capital from our limited partners is not having an industry because I didn't start off in an industry, right? I started off
Right.
from real estate, raised a lot of capital over the years, but it's been like entrepreneurs, business owners. It's been a hodgepodge, and I hear exactly
Right.
what you're saying.
Yep.
There's very little financial information or financial education from somebody getting into some field that they're making $250,000, $500,000 a year, other than max out your 401k or use your IRA. So it's interesting
Exactly.
that you say that. So that's crazy.
Yeah, and for anybody listening that has a business, boy, I just can't say strongly enough that niche down. I
Yeah.
can't tell you how many people over the years told me, "Oh, why would you want to pigeonhole yourself to just pilots? You should broaden your audience." And I ignored that advice because,
Mhm.
if you're speaking to everyone, you're speaking to no one.
That's right. That's right.
Yeah.
For sure. And that, like I said, I was telling someone the other day, when you move from being a deal guy where you're just like a few investors and you're raising capital, getting the debt and stuff, and you're the operator like myself, a sponsor,
Right.
or the GP, when you add on the capital raising engine of needing to raise capital, compliance, securities attorneys, management of capital, portals, it's a whole separate business.
Oh,
And
absolutely.
to your point, you need to niche down at some point
Yes.
because, if you're for everybody and everyone has their own internal problems going along with their type of business, right? You know, go
Well,
ahead.
and as an operator, you can niche down on asset class,
Yeah, yeah,
and
for
and
sure.
within the asset class on a specific market, on a
Hmm.
specific, size of I mean, you can get very, very specific, and you can be that specialist. It's like, if you wanted to get your knee replaced,
Yeah.
would you just go to the ER and and be like, all right, any doc you'll do, right? It's like,
Yeah, yeah.
no, you want to go to the knee doc, the
Right,
knee surgeon who specializes in that's all he does all day
right.
is knees.
Knees.
That's it. And it's like, that's the kind of real estate opera you want to work with. You want to work
Right.
with the person who's like, this is all I do day
Hmm.
in, day out. That's it. I'm the best at this specific type of real estate. And it's
Right.
like, that's great. That's who I want to invest with.
Yeah. And it's funny, like you said, other people don't have that because like we do
Right.
multifamily. That's it.
Right.
Class A, Class B multifamily, San Diego, Hawaii.
Yep.
That's all. So it's almost
There you
like
go.
we
So
know
you
it.
know those markets.
Yep. Know
It's
the
like
players,
you're the knee
everybody.
specialist.
Yeah, yeah. And and I always tell people that I use a similar thing. I'm like, because I used to do MMA and stuff like that. I was like, if you get injured in sports, you want to go to one, the specialist that's going to, let's say, fix your knee, but you also want to go to a specialist that works to get you back into the sport that you did.
Right.
So, because like you said, there's a specialist inside of a specialist because you know, some guy will make you okay to go, to fix your knee enough to get back to walking, and the other one is
Right.
going to make you good enough to get back into the ring.
Absolutely.
Totally separates. So that's
Yep.
interesting. That it really is. So based on what you've experienced, because you guys have how much under management right now for assets?
That's 70 million in equity. I mean, that's invested across because we're not the full.
Say that one more time. I lost you there.
I was saying we have about 70 million in equity under management,
Mhm.
and we're not the full capital stack on a lot of deals. So I mean,
Yeah,
that's
yeah.
invested across 2 billion, maybe 3 billion in assets.
Yeah, and no, that's great because you're doing it right. I hear a lot of people they do like the fund of funds and stuff like that, and they're kind of they're not diversified enough if they're going to do a fund of funds to make sure that their
Right.
investors are good and covered. It's like one or two things and that's it. And I'm like, if you're gonna do it, do it. Banks don't do it that way. They do it the right way.
Yeah, I
So
mean,
that's interesting.
we built our company from the ground up to be asset class agnostic
Hmm.
and not vertically integrated.
Mm,
We hear all the time about firms that are vertically integrated, which is great.
right.
But understand that, you know, Victor, you said you do multifamily, you specialize in multifamily. If you wanted to pivot and you were like, you know what, multifamily's dead, which it's not. Multifamily is on the
Yeah.
rebound. It's a great time to buy multifamily. But hypothetically, let's say you said, you know what, I want to be an industrial guy now.
Yeah.
It would take you years to pivot
Hmm.
into the industrial space because there's different brokers,
Yeah.
there are different market dynamics, there's different builders, there's different underwriting. There, and if vertically integrated over here, now
Mhm.
you've got, multifamily underwriters, construction teams, property managers, none of which understand the industrial
Industrial.
space, the industrial
Yeah.
vertical, right? And
Right.
so we have purposely, because we wanted to build our firm to be very diversified and very to be able to participate in all these different verticals, we purposely said we're not going to be vertically integrated. We don't want to operate. We don't want to hire an in-house property management firm. We don't want
Hmm.
to underwrite. We don't want any of this stuff. We want to be horizontally diversified across all of these different verticals. And we're going to partner with best in class in
Mm.
each one of them. And so when we go out and we find an industrial deal, it's like, okay, well, we first go out, we scour the landscape, we figure out, okay, how do we want to participate in this? We sort of identify macroeconomic trends. We decide, all right, do we even want to buy industrial? And if we do, who are the absolute top teams in the country that we can partner up with
Yeah.
and join that team from a capital and a marketing and
Hmm.
an administrative perspective,
Yeah.
so that we can bring our investors some a top deal within the industrial space, so to speak.
Yeah. Yeah.
And we do that within all of these different verticals. The only caveat would be oil and gas, which we are bringing in-house. That's the first vertical that we've decided, we
Mhm.
want to triple down on this, and we brought those capabilities in-house as of 2026.
Yeah, I saw you guys were moving into the oil and gas space, man. That's huge. That is. That's a good play.
So it balances real estate very nicely because it
Mm.
works completely the opposite.
Yeah.
It's very high cash flow,
Hmm.
and at the end, the asset's nearly worthless. If you're doing, shale non-op stuff, non-operated working interest, which we can get into if you want. But
Yeah.
yeah, I like it because very, very attractive tax benefits
Mm.
for W-2 professionals. Year one write-offs of 85 to 90% that you can use against W income, which is, as we all know, real estate is wonderful for tax benefits, but unless you're a real estate professional or it's a short-term rental, you can't use it against your W-2,
Yeah.
and
Yeah.
it kind of sucks.
Wow.
But oil and gas, you can, even though you're a passive investor, you can take those losses against your W-2, which is very powerful, and then you get very strong
Mm.
upfront cash flow over the first few years, which just increases your IRR and increases that velocity of money as cash is coming back to you faster. So it balances. It's not the end all be all. I don't want all my net worth tied up in oil and gas, but it balances real estate holdings very nicely just because of the tax benefits and cash flow.
Yeah. Yeah. The tax benefits are more the offsetting the losses from that perspective.
The tax benefits come from well, two things up front:
Hmm.
intangible drilling costs and tangible drilling costs.
Okay.
So if you were to go and drill well, let's say it's going to be a horizontal well, and the first thing people say is, "Well, isn't that risky?" And it's like, well, it's not as risky as it was even 20 years ago.
Yeah.
The advent of horizontal drilling significantly reduced the risk, even though
Hmm.
these wells are more expensive to drill.
Yeah.
The the number of non-commercially viable wells nowadays is actually very, very small.
Mm.
2-3% of wells that get drilled are not commercially viable.
Wow.
And
Okay.
you can buy a small working interest in a well that's being drilled by EOG, Continental, Devon, you know, big, big players.
Yeah.
Continental, for example, is the largest privately held company in the United States.
Mm.
They are
Okay.
massive.
Wow.
And you can actually participate in their well, and they're the operator and they own 90% of it. And so they're
Mm.
financially incentivized to make sure that they drill
That it works.
a commercially viable well, and you're getting
Yeah.
to ride those coattails. So if it's a $15 million well, the bulk of that is going to be spent up front on land acquisition, intangible. The tangible stuff is the actual things that you can touch or resell, like uh, you know casings and drill bits and things like that.
Right.
But labor, intangible. Land leases, intangible. Frac fluid,
Mm.
fuel. All of those things are intangibles, and so the IDCs or intangible drilling costs plus the bonus depreciation on the TDCs, the tangible
Okay.
drilling costs, is what can give us those, like, 80 to 90% year one write-offs.
Yeah.
Um, and then the income that comes back off of it is also tax advantaged, where the IRS just gives you a flat 15% right off the top. So
Oh, I
let's
didn't
say
know
you
that.
invested 100K and, first year you get 50,000 back in cash flow. The first 15% of that 50,000
Hmm.
is tax free. It's called a depletion allowance.
Oh,
And
really?
so the rest of it is going to be taxed at your ordinary income tax. It's ordinary income at
Right.
that
Right.
point. But you get that nice fat tax write off in the beginning, plus the 15% of the income in all the subsequent years is tax free. And then there's no depreciation recapture on the end, as long as you sell the assets for less than your taxable basis. And this gets a little bit complicated where, when you're, as a fund manager, when you're wrapping up and disposing of these assets and you're selling them back onto, the secondary market, and there's a very
Yeah.
healthy market for PDP, proven developed producing assets, where you're taking almost like if you built a multifamily and you
Yeah.
operated it for 5 or 7 years and then you sold it.
Yeah.
But in this case, you'd be selling it for maybe 15% of what it cost you to build it, because
Okay.
you've extracted most of the minerals out of the ground at that point. But the person that's buying it secondhand is getting a good deal, and they're getting about 20 or 30% net um, uh, day one cash flow on that asset, and that
Hmm.
can produce for decades.
Yeah.
So there's a very healthy market. But as long as if our taxable basis is, let's say, 15%, we sell it for 14%, there's no
Right.
depreciation recapture on that pop at the end.
Wow. See, and this is what you were talking about in the beginning. Like, you need to know your stuff
Right.
right off the bat. Is like,
Helps to be
'cause
able to explain too. There's a lot of people that know this stuff, but they aren't able to articulate it very well.
right, right. And I think that's the distinction too, right? Because like you've been in real estate, you've done stuff. So I think the for you to be able to explain something to anybody, also is probably coming off the hooks of that, as well as, you have other skills of communicating. So I think that's
I
cool.
think I think it was I'm very fortunate to have spent years as a flight instructor. When I was
Mm,
18 years old, I was teaching people on airplanes, 18, 19, 20, and then for 6 years as a check airman for my airline, teaching in the simulator and in the jet. And that was definitely helpful.
yeah. Yeah, I could imagine, dude, because everything you said, I'm tracking. And naturally, I have an understanding because I'm processing it from a real estate perspective. Okay, this is
Right,
cash flow, these are returns and taxes
right.
and things like that. So I can catch it.
Yep.
And I just look at I'm from Texas, so originally, so I get it, with the oil in Houston and things like that. So I know a bunch of guys around that do the oil and gas investments.
Yeah.
So it's interesting, but you made it probably more interesting listening to you talk about it from an investment standpoint than just, you know,
When if you really want to get into the weeds, I co-authored a 30-page ebook with my tax strategist,
yeah.
who has a master's in taxation and lives in Oklahoma City, in an ebook called God, we probably should have used a shorter name, but it's like the Guide to U.S. Domestic Drilling Tax Benefits or something like that. Anyway, I can send it to you if you want. It's a
Yeah.
good book.
Okay. Yeah, yeah, definitely, man. I would love to read it and check it out because again, like I like to understand what somebody's doing just so like because I'm gonna meet people who want to do that and I want to make sure to be like,
Right.
hey, you know what, you should talk to Tate. So, man, that's interesting to me. For one, I'm interested in anybody who's like, again, in the space of like, hey, we deal with investments, we're growing, we're trying to scale our company and do something big.
Right.
And there's so many other different opportunities out there for people. And if you just, like you said, yes, you need to drill it down, but you also need to understand other people's stuff as well. So that way, as you're
Definitely.
connecting and because it's a relationship business.
And speaking of relationships,
Hmm.
I want to make sure that I share the fact that I don't ever want to be the smartest guy in the room. And
Facts.
when I say we're bringing these capabilities in house, I literally mean we've brought our oil and gas used to be consultant. Now he's
Mm-hmm.
the managing partner of our oil and gas division. 30 plus year veteran, lives in Houston, knows everybody in the
Mm-hmm.
space. I mean, we've been able to acquire incredible talent, and that's the key is putting teams together that where you're hiring for specific skill sets for depth of knowledge.
Right, right. And that helps when you talk to an investor and say, hey, we have somebody specifically in that doing that. So, like you said, I agree with you. I actually willfully tell people I'm not the smartest guy. So, I'm usually going to look for something pretty simple to get something done with, or somebody who's way smarter than me.
We always say if you're the smartest person in the room, you're in the wrong room,
Yeah,
right?
you're in the wrong room. So, for sure. So that said, so what do you think? And I'm in the multifamily space, and I'm sure you've probably seen it. And I think a while back, you guys don't have storage stuff as well. A while back, this was years
We
ago, right?
do.
Yeah. So what do you think? And you've
We
seen
do. We actually did one last year as well
really?
in
Okay.
2025 in Houston, actually
Okay.
a big institutional grade
Mm,
facility. Yeah.
okay.
Seven properties. Yeah.
Oh, nice. So that's a big site. That's a big site. So,
Yep.
so what do you think some of the mistakes you watch other people that are in our space do, like other people who are syndicating and managing other people's capital to make investments? So, I mean, especially now, rates have changed, underwriting needs to be tightened up a lot, especially in any
Yep.
long-term investments. What are you kind of seeing some of the things that are happening and you guys are avoiding, and I can avoid too?
I think the biggest thing is the debt. I mean, if we look at the last cycle, you know, for anybody that is new to the real estate space and might be thinking, you know, you're just jumping into it.
Yeah.
For context, it was bad in 2008, but
Hmm.
it was bad for everything.
Yeah.
And so it was very easy to see that it was bad.
Hmm.
This time around, the economy has been doing very well, but
Hmm.
we've hit a massive downturn in the real estate cycle. And,
Yeah.
2022 is about as bad as it gets in
Hmm.
real estate. I mean, there are tons of properties that went back to the bank.
Yeah.
LPs wiped out equity. I mean,
Hmm.
it was bad.
Yeah.
Yeah, but it was unique in that it was juxtaposed against a stock market that was ripping and an economy that was doing overall very well.
Yeah.
I think that, again, if we go back to the last two cycles, where did people lose money?
Hmm.
Where they were over leveraged
That's right.
or where their debt, it was always because of the debt. And 99% of the time when people lose money in real estate, it's because of the debt.
That
So,
1000%.
and I find it so funny that a lot of pitch decks don't talk about the debt.
Hmm.
Um, you got to dig for it. And it's
Yeah.
like, what's the debt? What's the debt? And it's like, oh yeah, yeah, yeah. We got it through this credit union. It's going to be great. And it's like, and that's the most important piece of the
Yeah,
entire deal.
that's right.
Because if you don't have flexibility
Hmm.
and you get yourself into a bind, the debt can eat you alive. And that's what can cause investor losses.
Right.
I think that debt is totally fine. It's a tool, but you got to be careful with it.
Hmm.
And I use the example of Dave Ramsey drives me nuts. It's like, oh, live debt free, and it's like, you know why would you drive from Los Angeles to New York when you can fly?
That's right.
But if you don't know how to fly a plane, you probably shouldn't get behind the controls and
That's right.
try to fly yourself, right? So Um, but it's an amazing tool. It's like a chainsaw versus an axe. It's like you chopping down a tree with an axe where you could use a chainsaw. But if you don't know how to use the chainsaw, you can get yourself in trouble.
Uh-huh.
Or if you're not using, say, proper protective gear, you get where I'm
Yeah,
going
I
with this.
do.
I think that the debt profile also needs to match the risk profile of the deal.
Hmm.
So let me give you an example. We bought a 1,300 acre parcel of land with a golf course in Colorado.
Uh-huh.
This is an entitlement deal. We're going to do really well for our investors, but we put zero debt on that project
Mm.
because it was already risky enough, and we knew
Yeah.
that the biggest risk to the deal was timeline, and that things just take way longer, and the timeline rolls to the right. Well, that's a perfect example of a deal that if you were to lever that to 80%,
Yeah.
you could just get eaten alive,
Right.
and you could lose all your investor equity really easily.
Yeah.
With zero debt on that project, we almost don't care what happens. It's
Yeah.
like the economy could go down the tubes. I mean, it's like, well,
Yeah, we own it.
we just sit on it. We
Yeah.
just wait. It's
That's
like all we
right.
got to do is service the property taxes. It's no big
Hmm.
deal. And it's the same thing that happened with people back in 2008. If you bought a house in '07, 100% cash, and it cratered in value by 40%, it's like, do you care? It's like,
Yeah.
yeah, it's a bummer, but you're not going to lose it to the bank.
Right.
You're just
Right.
going to wait for the value to recover, and you're getting cash flow in the meantime. It's no big deal. So you can either lever up or lever down the risk on a deal depending on what kind of debt you put on it. So
Yeah.
I think that we're in a very healthy point of the market cycle right now. I actually, your question was, what are you seeing people do that makes you nervous, and what should we stay away from? I actually think that this is one of those points in the market cycle where um, it's like a powder day skiing. It's very forgiving.
Yeah.
You could probably make a lot of mistakes right now and still
Hmm.
look like a genius in 3 years, but you got to keep your eye on that debt piece.
1000%. 1000%. As a matter of fact, I know I was talking to somebody and they were like, well, you didn't take down anything last year. And I was like, well, the debt market's still
Yeah,
not friendly. I had a choice. I can raise,
right,
yeah, you raise all the capital, like you said, and like, hey,
right,
let's do a deal and we raise the full 50 million and we go in on
right.
that deal and we just sit and wait and then
But
recap. Yeah,
but that dilutes your investor
it
returns, right?
does.
Because
It does.
we're
So
spreading the returns across a whole lot more dollars. Yeah.
exactly. So, and to your point, like I learned the business in 2008. Well, I learned the business in 97 and 98 and through buying defaulted property, things like that. My partners they used to buy defaulted notes, things. So, and I kind of got into smaller deals when I was younger, but I would just renegotiate the debt, restructure it, and then keep the properties as rentals and income. So it's like I understood the
Yep.
pressure of someone having a great property and their debt does it.
Absolutely.
Even I was talking to someone about this the other day. I was like, even some of the in your debt, you can have a good commercial property and the market goes down and you're in technical default because the value of your asset went down and now you're getting called to the carpet and people are talking to you
Right.
about those things because there's a mark to
Right.
market. But when people don't understand that, they're just like, oh, they don't really get how important debt piece is. And I just finished having this.
Absolutely.
I was like, your debt is your first partner.
Yep.
So
And they're the biggest piece of the capital stack.
They
You know,
are.
everybody forgets that, you know, the bank is putting up 60%, 70% of the capital stack. It's
That's
like
right.
they are your number one partner
That's
in the
right.
deal.
Yep.
Right? So,
It, and you are going to have that phone call and they want to know what's happening to, to that asset every quarter. You're going to be turning in documents. They're going to be looking at it. They want to know where
yeah,
you sit and how things are going. And that's how it goes. I mean, it really is. So, I mean, it's interesting because I have, and thanks for sharing that with people and knowing that because very few people do that. They're like, they want to know a lot of questions, but it's like, hey, the most important piece about this thing is the debt.
yeah,
And for us, we look at Fannie, Freddie, life cos, debt funds, things like that. And I'm like, if you can't, if they're not interested long term, then you should probably be leery of that,
yep,
um, because it does matter. It really does. So that's interesting.
yeah,
Cool, man. So,
absolutely. Couldn't agree
man, thanks
more.
for that. That's great. And everybody listening should take that, without any other advice. The best thing you should always do is look at that. So, what do you think, before we jump off, and I appreciate you, man, I do. What do you think it really does take for anybody to become, I'm using the word, but because it's a broad term, but to become a major player in their space at what they do?
I think you need to lead with value. I
Hmm.
think, you know, you need to lead with knowing your stuff. You got to be well studied. You have to, you know, dedicate yourself to the craft.
Yeah.
And you really have to enjoy it. You
Mm.
know,
Mm.
you you look at any major sport player and you know, they didn't get into it because they wanted to make millions of dollars.
Right.
They did it because they love the game.
Hmm.
And you know, Steve Jobs said this years ago, and it was you know, if you want to be an entrepreneur, you have to be very passionate because it is so hard that if you're not passionate, you'll give up.
Hmm.
And so I think it has to start with an internal drive and a passion for something. It then has to follow with, you know, a love for the journey and a love for the craft
Yeah.
and with study and with knowing your stuff and with surrounding yourself with big players, you know,
Hmm.
people who are doing bigger things than you. And then it just
Mm.
takes consistency.
Yeah.
It takes getting up week after week, month after month, year after year, when it's not fun anymore, when it's not exciting anymore, when it gets boring, that's when the rubber meets the road.
Yeah.
It's like, yeah, that's what it takes.
There you go. That's what's up. I love that, man. And you're right. Like I always tell people, like when it becomes just like driving through the McDonald's drive-through and you already know what you're
Right.
gonna order and it's so mundane, that's when you know you've hit it. It's like you're gonna order a number one
Yep.
because the menu hasn't changed. And that's excellence.
Yep.
That's
Yeah.
cool.
Yeah.
Well, cool, man. So how do
When that,
people get in contact with you and what you're doing for people who are interested in investing with you or talking with you or your team or any of the groups that you run?
yeah, absolutely. So my direct email is Tait, Tait, at turbinecap.com, TURBINE, like turbine engine, CAP, like capital.com. So
Hmm.
our investor relations line is investors at turbinecap.com. That comes to myself as well as our IR team.
Okay.
You can also check out our website, Turbine Cap, and our podcast. I got to say, is pretty good. We hit a lot of advanced tax strategy, trust and estate planning, all sorts of cool topics. So
Nice.
check us out, Passive Income Pilots, and that's on Spotify and Apple. Come check us out. Yeah, thanks,
Perfect,
Victor.
man. Perfect, man. I love that, man. And we got to do some stuff together here soon, definitely. Okay.
Absolutely, would love
Cool,
it.
man. Hey, thanks so much for jumping on with me, man. I really appreciate you, bro. I really do. Thanks for everything.
Pre-
Cool.
Appreciate you having me. Thank you so much.
For sure, brother.